There was a big shake-up at Nine Entertainment Group this week, with Chief Executive Mike Sneesby announcing he'll step down from his role at the end of this month. Sneesby's departure comes just 3 months after long-serving chairman Peter Costello left the troubled media business. Now, to discuss this and some of the other big market stories this week, I'm joined by Bei Liu from Tribeca Investment Partners. Bei, thanks so much for your time. Let's start with the departure of Sneesby from Nine. There were rumours this year that he might be leaving. Now he's finally finishing up before this cultural review into misconduct's completed. What's the outlook like now for Nine?
Look, the outlook is very challenging, and increasingly now without a chief executive, it's going to be very, very difficult. And this is also all happening during a time when the advertising environment isn't great for television at the moment. Of course, within Nine, the big part of the valuation for Nine is the investment in Domain. There's even now speculation whether the Domain stake can be floated out. Of course, they deny that. But now that with changes in chief executive, there's every possibility there's a lot of restructure will take place. Yeah,
Sneesby was very effective when he ran the streaming platform Stan for about 7 years, but once he got promoted to Nine, didn't seem as effective. We can have a look at the share price for the last 3 years, which is basically his tenure. Is that the main way you rank a performance of a CEO?
Unfortunately, it's the CEO's performance often ranked by the share prices, and that's
down almost 55%.
Look, absolutely, and it's unfortunate for him that the advertising cycle has been very tough. And quite frankly, Stan was meant to be the star of this whole group, and it just hasn't really got there. I think and then the question is, what is left of this business? I think it's been a very challenging environment.
Yeah, we know Domain, the property platform, has had its difficulties. There's obviously the decline in advertising. There are now potential new laws to remove gambling ads from TV. And then you've got big global streaming companies like Amazon and Paramount and others trying to really take over our market. So it does look like a pretty tough time.
Oh, absolutely. And, for Nine, unfortunately, just nothing is working. Even Domain is meant to be coming through on the other side of the, property market where, market's improving a little bit, listings doing a bit better. But just unfortunate for Domain, they seems to be just losing share to realestate.com. And, so, quite a lot of restructuring needs to take place.
They might have a new, they've got a temporary chief executive right now, Matt Stanton, the CFO, but they're looking for a new boss. How quickly do you think they can actually find someone to get into that job?
That will take time. I really think they need to bring someone from externally to really trying to drive the change and to restore confidence, I guess, to the stakeholders. So, and that will take a month, I would think.
All right, look, let's shift over to another big story this week. There's been a real reversal in fortune for lithium prices. What's really happened over the past few days?
Look, aside from the share prices, the lithium price has really been bombed out. And it
hasn't been doing well, has it?
That's right, not at all. And this recent rally is really nothing compared to what it lost even in the last couple of months. So, But what's happening is that we are now seeing large lithium miners in China cutting production. Now, often in a commodity cycle, when the commodity price falls to a point where people started cutting mines and stop producing, this is usually a good sign. They're showing that this is probably the bottom of the prices. And this is the hope that this will be the bottom. But the challenge is, it's not just China, it's in Africa. There are so many new productions coming online. You need all of those lithium miners to do the same. Then you can see the stabilization rather than just the blip for the time being.
And is it really connected to the electric vehicle market as well? Are sales in electric vehicles potentially not doing as well as they were previously? And that's one of the reasons why supply's kind of been high at the moment for lithium.
Absolutely. I think you're very, very right. And then, 5 years ago, we thought the electric vehicle will be dominating the world today.
Yeah.
But we are seeing that they've done incredibly well. But now there's more shifting towards a hybrid vehicle instead of electric vehicle. And the challenge is then you look back at all the supply chain, how much lithium you require and the like. Suddenly the demand outlook isn't that great. And at the same time, your supply continue to come on. That's why you see that disconnect in prices.
Well, the other commodities as well this week that have really picked up, smaller ones, uranium, titanium, nickel, and it seems to be all due to Russia potentially thinking of curbing their exports of those things. So this is just a basic supply and demand story.
Absolutely. So again, these prices have fallen quite a lot, and again, it's the more risky investors with high risk appetite is now taking some position in some of those names, thinking potentially it will create shortage. The tight supply and demand is quite tight at the moment, but potentially will create more shortage in some of those names.
Now let's just move on to retail. We're in the first couple of months now of the new financial year. We've got every Australian's getting a tax cut, energy rebates, particularly to Queensland. Is that going to have a positive impact on spending and the retail sector? Are things looking a bit better? Yeah,
well, actually, you're absolutely right. And I think we're already seeing some of those impact coming through. Trading updates coming out of all the retailers a few weeks ago have been pretty solid. The likes of JB Hi-Fi and others all talk about reasonably positive, growth compared to last year. So that's been pretty solid. And foot traffic is pretty reasonable as well. And the hotels and restaurants in particularly Queensland has been incredibly strong. So, we are seeing the positive news flow coming through. But I would, sort of put a sort of caution in there is that last year, we're comparing to a very weak period last year.
Right.
So, yeah, as we progress towards, sort of December, it's going to be a little bit tougher. So I do think that retail will potentially likely to be softening into December. But it's not cratering, it's just a little bit softer, given consumer is a bit more cautious before we're seeing the potential uplift when we get our rate cut.
Say we get rate cuts in February or March or April next year in the second half of this current financial year. That's obviously going to help the whole retail sector and the economy in general.
Oh, absolutely. And then I think there is a lot of hope that will come through earlier, but Australia is going to weigh, and in a way it will be important to see some softness in the retail for RBA to actually think about contemplating cutting rates. So the good news is, yes, it's coming through early next year, and it'll be very strong for our economy and also the retail sector.
Now, one retailer that didn't lodge its financial reports in time, or they're unaudited at this stage, is Satire, the online fashion, luxury fashion marketplace. Its CEO's been buying a lot of shares to really try and build up the share price, but has that business in a bit of trouble at the moment? Or?
Yeah, look, so that's the business that has been so bifurcating, and it has a lot of controversy around it. And the challenge is the business, sort of recently gave its week trading update, and share price fell significantly. And then since then, aren't able to lodge its account. So really has created a lot of doubt and questions about why is that the case. And at the same time, why is CEO able to buy the shares when the official account hasn't been really lodged? So, just there's a lot of questions about it. And, I think, right now, just very hard to see it's being investable.
Yeah, I think the report will be coming out in September, possibly. One of the issues might be the way revenue is reported from both their side and from the customer side. So it's quite difficult.
Yeah, that's right. So, look, my view is that you're a retailer, it shouldn't be that difficult to recognise the revenue, and the fact if you have to push some aggressive envelope as a retailer, things probably is doing a bit tough. So, so my view is that, look, it's just making it very difficult for new investors to really look at this business.
Now, there was only 6 companies in profit reporting season that didn't lodge their financial reports in time, and the other big one was the Star Casino. Obviously, they're in under quite a lot of pressure. They're now their shares are suspended on the stock market. They're talking to lenders. I mean, is a casino business, can they still be profitable in this tougher regulatory environment? It's not like it was 5 or 10 years ago. Oh,
absolutely. Look, it's really, really tough environment for them. And then with governments, aside from all the reviews that's going on and the fine they will need to pay, the government's, imposition of all the hiked tax a few years down the track, really making this business writing down pretty much all of its assets. It's really difficult to see them, coming through as the business it was. So look, there's still a lot of last-minute negotiation need to take place, it's a very tough spot for the business at the moment.
Bei Liu from Tribeca, thanks so much for your time.
Thank you for having me.